Good morning, everyone, and welcome to our January 2021 NAIOP Georgia meeting. I'm Shep Dinos with Atlanta Property Group, and I'm honored to be your 2021 president and excited to work alongside our amazing board. I'd like to first thank Ryan Hoyt and his committee for organizing this event. Jeff Rosenzweig has presented at NAIOP events in the past, and they've always been tremendous, and this one will certainly be so as well. 2020 was an unprecedented year, and 2021 will certainly bring its challenges. With the commitment of you, our members, and the hard work of our board, we have managed the pandemic effectively and are well positioned to move forward together in 2021. NAIOP Georgia remains focused on our members and is committed to bringing timely, high-quality programming. While virtual events will remain for now, we are hopeful that we will be able to return to in-person meetings and events at some point this year. I am excited to work with our board on our goals for 2021, which include maintaining our chapter stability, membership benefits, and continuing our diversity and inclusion initiatives. We have a phenomenal committed membership, and I have no doubt that 2021 will be a successful year. And now on to some NAIOP announcements. I'm excited to announce that we will be back this year for our 29th NAIOP School Challenge with all 4 universities participating: Emory, Georgia State, Georgia Tech, and the University of Georgia. David Haddow has once again produced a phenomenal case. The students will begin working this week, and we're excited for the event. I'd like to take this time to thank Greg Bowler and his committee for all their hard work. Please stay tuned for more information on this event. And now I'd like to thank everyone who has contributed thus far to our Ron Clark Academy Scholarship Fundraiser, helping students attend this great school. We are very proud of our partnership with the Ron Clark Academy, and many of the Ron Clark Academy staff, former students, and students are a part of the NAIOP family. Unfortunately, we are not going to be able to present a check to the Ron Clark Academy in February like we have done in years past. And so in lieu of that, I would like to encourage all of you to help participate in making this fundraiser a success. When you end this program and you look in your email inbox, you will see a link, an email with the link to the fundraiser. We are a third of the way to our goal of 18,000, and so I'd like today to be the day that we make our final push towards the goal of 18,000, and would appreciate all of y'all's support. And now I'd like to recognize our sponsors. We appreciate your loyalty and your support. BB&T SunTrust, now Truist, Brassfield Gorey, Highwoods Properties, Majestic Realty and Company, Mayberry Electric, Nelson, Ryan, and Troutman Pepper are platinum sponsors, and KBD Group and Randall Paulson are premier sponsors. If you're interested in becoming a NAIOP Georgia sponsor for this year, please contact Debbie Koenig at NAIOP Georgia or Brandon Houston at Trammell Crow, our VP of Sponsorship. At our December board meeting, our 2021 board was approved. And so now I'd like to formally introduce the 2021 NAIOP Georgia Board of Directors. Myself, Shep Dinos, President; John Grimsley of Highwood Properties, President-elect, Treasurer; Maureen Callahan, Troutman Pepper, Secretary; Jennifer Kuntz, Pope and Land Real Estate, VP of Communications; Gregory Bowler, Transwestern Development Company, VP of Education; Annie Baxter, CBRE, VP of Governmental Affairs; Suzanne Markley; Ryan, VP of Membership and Diversity; Mike Wells, Highwoods Properties, VP of Philanthropy; Amy Curry, Hillwood, VP of Programs; Ryan Hoyt, JLL, VP of Special Events; Brandon Houston, Trammell Crow, VP of Sponsorships; Blake Underwood, the Dillwig Companies, our Chair of Mentorship; Christine Curry, Seelig Enterprises, our NAIOP Future Leaders Director; and Debbie Koenig, our NAIOP Georgia Executive Director. As I mentioned earlier, continuing our diversity and inclusion initiatives is one of our top goals for 2021. Greg Bowler, our VP of Education, and Suzanne Markley, our VP of Membership and Diversity, along with our task force, have been hard at work on one of our diversity and inclusion initiatives, which is the NAIOP Career Internship Program. And so now I'd like to ask Greg to join us to give an update on this exciting program.
Awesome. Good morning, everyone. Hope everyone is doing well. I am Greg Bowler, a partner with Transwestern Development Logistics Group. I'm honored to serve as this year's Education Committee Chair and to co-chair this great program with Suzanne Markley and speak a little bit more around the Career Diversity Internship Program. And so, this internship program is essentially a platform that is being led by NAIOP Georgia chapter to where we will handle the outreach of recruiting directly at Georgia State and the AUC for minority students, and specifically looking for those that are majoring in real estate, business, English, poli-sci, all the things that we feel like are transferable skill sets in this industry. Doing that initial outreach, doing the vetting, and then providing that vetted list to our membership companies. This program started, going back to November of 2019, when NAIOP decided on changing from more of a national exposure type of focus on diversity, and that was through the Nexus program, to being more at a local and focusing more on access type of impact. And we just felt like that was the most effective way to do that. And so, we've been working on this opportunity. We've been speaking to a myriad of companies, and thankfully we've been able to get formal commitments from a good bit to where now we are able to place 10 interns this summer. And so we want to thank our partnership companies, but we also want to thank the firms that were very transparent in sharing their internship opportunities and their existing diversity and really just providing their feedback. It was all extremely helpful. We have seen strong interest from these students at Georgia State. The AUC, their spring semester starts in the AUC, to be clear, that's Atlanta University Center, which includes Morehouse, Clark, Spelman. They start their spring semester next week. And so we do plan on meeting with them directly and letting them know about the opportunity. But we're excited. This is definitely going to happen. And it's a first initiative of our kind, but we think it's sustainable and something that we can continue to grow and have a more great impact. So thank you a lot. Appreciate you.
Thank you, Greg, for that update. And now I'd like to turn to the main part of our program. We are pleased to welcome Jeff Rosenzweig back to our January forecast. He is currently the Director of Global Perspectives Program at Guazetta Business School at Emory University, where I'm sure many of you in the audience attended, including myself. He's quoted in Forbes, Fortune, and Business Week. You have most likely seen him on the morning news shows and as a commentator on CNN. Professor Rosenzweig specializes in financial, macroeconomic, and business forecasting, and was formerly a senior global economist with the Federal Reserve of Atlanta. A little bit of housekeeping before I turn it over to Jeff. We are going to have question and answers at the end of the program. So just throughout the program, if you have a question, go ahead and click on the Q&A button on your Zoom toolbar, and we will get to those questions at the end of the program. And so now it's my pleasure to introduce Jeff Rosenzweig. Jeff, take it away.
Well, thank you, Shep, and it's good to see an Emory man be the president. And Greg, I'm impressed with what you're doing. I always like to give one suggestion, which is also think about including Agnes Scott College. First of all, it'd be great to see more women in a diversity initiative. And like Spelman, it's all women, and there's a tremendous amount of women of color, which most people don't realize. So I would like you to think about that as well, just to throw something new in there. Well, we're going to talk about not just the economic outlook, which you get too much of, but also the financial outlook, since I'm a finance professor. So we'll get right into it. I'll move right to my first slide, and I want to give you what a consensus of forecasters around the world are telling us about their forecast for economic growth. If it was just my forecast, I could bring my own biases to it. So in red is the forecast for 2021, dark blue 2023, and I go all the way through light blue at 2025. Now, to start with, I don't show you 2020. First of all, it's the past. In real estate, we're always interested in the future. But in 2020, it's easy to summarize. Every economy declined. Instead of growing, they declined, except, interestingly, for China. China's economy grew, not as fast as in past years, but picking up momentum once they opened up all their factories. What they did is they locked down very severely, of course, in Wuhan, where things started. And by locking down severely, as you know, China has very few cases of COVID and really has their economy wide open for retail, for manufacturing, for industrial. So China, ironically, where the pandemic started, is the only economy that grew in 2020. And it will continue to grow quickly in 2021. And as you can see, the next country over, India, is also expected to grow fast in 2021. Now, notice that I rank these in descending order. So if you're already on the left, China, you're expected to be the fastest growing economy. As I said, they're not ravaged by the pandemic, where India is, and Brazil, and the US, and some of Europe. Even now, our economy is at some risk due to this third wave, this surge we had in cases. If you've been looking, the last week, cases seem to be going down in the US. This is good news because they surged so much, and in Georgia, as well as the US, that a number of us had a fear that we would have to have partial lockdowns like they have in California and a little bit in New York, and we could maybe risk a slight double dip recession after what was a depression more than a recession in March, and particularly in April. So in every case, these are, by the way, all the large economies. In every case, forecasters are looking for a bounce back effect. Since there's a lot of excess capacity, and you know that in real estate, other than warehouses, basically, since there's a lot of excess capacity, all these economies are expected to grow faster than their long-term average in 2021, and then settle down toward their long-term average. If you look at the US, and if you look at Canada, which is very closely tied to our economy, same thing with Mexico, since we're in a free trade area, we sell so much to each other that if one does well, the other does well. 2022, there will still be some catch up as we get back to where we would have been. And then we get more onto our long-term plane. Now, it isn't just Japan and Europe and the US that is aging rapidly, our labor force. It's China, because they had their one-child policy kick in. So their labor force is not being enhanced as ours has been by a millennial generation. They never had the millennials because of their one-child policy, but they had a large cohort of births before the one-child policy. So China's labor force is declining. Germany's is, because they never had that echo effect, that baby boom having an echo of itself and having a lot of babies, a millennial generation. Same thing, Germany is an exemplar here for what's going on across Europe. And if you look at Japan, they're going to grow barely over 1% their economy as we look out after their bounce back effect. And they absorb some of the excess capacity caused by the pandemic. The US, this is important from a standpoint of real estate. We are expected, the Federal Reserve says it, the major investment banks, we're pretty widely expected to grow over 4% this year. I want to give you a perspective. We were growing about 2.25%, 2.5%. This is real GDP, of course, inflation adjusted total production. So from that 2.25%, 2.5%, because we had a decline, now we can start absorbing some of that excess capacity and grow. People are saying like 4.25%. So there'll be some absorption of space. Although in the hotel industry and in offices, well, we can get that in the questions, but high-rise offices, for instance, are going to have some trouble. Maybe what used to be Class B or Class C, kind of older, two-story, you'll walk up the stairs to your office. People might start to prefer that than getting in an elevator with a lot of people. But in general, we're going to get back to our longer-term trend after we start absorbing space, but it won't be that 2.25%, 2.5% economic growth that we had been seeing in the Obama years, the Trump years, the George W. Bush years. As you can see, it'll fall slightly below 2%. And just about every forecaster is saying this. And it's because of the progressive retirement of the baby boom. As you know, a lot of baby boomers have already retired, but the peak years of the baby boom, those people are approaching 65. I'm an example. I was born the year more Americans were born than any year in history, and I'm approaching 65. So my cohort, et cetera, as we retire, we'll be like Japan and Germany and China. Not that we'll have a declining labor force as they will. Our labor force will grow a little bit, but productivity, output per worker is why these economies will keep growing. As technology is diffusing, there is a belief that innovation, if anything, it's accelerating, and we have AI coming on. We already have machine learning, and we'll have self-driving cars and trucks. We may get a productivity boost, output per worker, but the demographics look bad in the advanced economies and in China. And other emerging markets, they look better, which is why a lot of individuals, yourselves and myself, we're putting some of our retirement funds into widely diversified emerging market stock funds. They're volatile, but we think in the long run, a lot of the growth will be in emerging markets. So I'll move to the next graph, but as I move to the next graph, I'd like to talk about the very sharp, historically sharp decline of the US economy when we locked down, but a steady comeback since then, which a lot of people don't realize. This may be the shortest downturn in US history. For instance, the Great Depression started in 1929, a stock market crash, and then it continued basically for a decade until World War II spending stimulated the economy. There was a time in the middle when FDR got elected and did a lot of spending with the New Deal, and it got us out of the Depression for a while, but then we fell back in when the Federal Reserve tightened up the money supply too much. But even recessions often were last 8 months, a year and a half. Like as you all know, we had the housing and commercial real estate kind of boom up to about 2006, 2007. Then that bubble burst, and we fell into the global financial crisis because it was a global phenomenon. And we had the Great Recession, which we thought was the worst thing we'd seen since the Great Depression, and it was. Unemployment rate went up to 10%. But this case, unemployment rate went up to 15% in April, and it was being mismeasured. It was really more like 17 or 18%. It's lower now, and I'm going to show you why it's lower. Because ever since April, in total, the economy has created jobs, and for a while, it created a lot of jobs. Now, I'm not showing the total here because I can describe it very simply. I wanted to show you major industries. And some of you are in the lucky part of real estate. Others are in the unlucky parts, like malls. Others are in ones that took a big hit but are coming back up, like healthcare. And some are in things like hospitality that are continuing to take a hit. So we'll break that down. You may find this interesting. as you talk to people. It's very simple. We lost 22 million jobs on net. Notice I'll always say on net. On net meaning, some people gain a job, others lose it. But adding that together, if you look at the net, we end up with 22 million less jobs. We lost 1.5 million in March on net, and then we lost 20.5 million in April when all the lockdowns started. In March, the lockdowns really started only at the end of the month. But in May, in Georgia, and as you remember, our governor was criticized, we opened up. Other states, most other states opened up later. So there was job creation in May, but it didn't mean all the jobs came back because it was kind of a partial opening on a nationwide basis. And progressively into June, there was more of an opening, and that initial wave of COVID came down when everyone was dying in New York in that area. And we were creating jobs steadily from May through November. And then I'll show you what's going on with the industries. Then in December, and most of you know this, we lost as a total economy on net, we lost 140,000 jobs. That got people worried. Like, are we falling again into a double dip recession? Will we go down again? But now that I look at the industry breakdown, I want to tell you something that some of you know, which is a brunt of the job losses has occurred in leisure and hospitality. Restaurants, bars, clubs, theaters, and hotels, for instance, to such an extent that first I show you in the light blue what happened in March. And again, for most of March, businesses were open. So jobs were lost, if you look at the light blue, but not a lot. On total, 1.5 million. But then the 20.5 million lost across the economy in April. And that's the red bars. So many lost in leisure and hospitality, I even took them off the scale. So the scale didn't have to go too low. As you can see, we lost 7.6 million jobs. Then with the opening, we started gaining jobs. Some restaurants open and either serve people outside or well socially distanced inside. Some people started going to hotels again. And we see a nice job gain of almost 1.5 million. On the scale, I should have said, we're using the left-hand scale, it's in millions. And by June, when every state was opened, we even gained 2 million jobs. But remember, you gain 1.5, you gain 2. Okay, so you gain 3.5 million back. We lost 7.5 million. And as you can see, we lost 750 000 in March when restaurants started closing down and people stopped traveling and stopped going to hotels. So we were gaining jobs. And then in December, we started having this third wave of expansion of new cases of COVID. Many people had traveled on Thanksgiving or at least gathered, gotten sick, and that was playing itself out in December because there's the time lag. And then we lost, as you can see, 500,000 jobs just in that one broad sector, leisure and hospitality. And because of that, total jobs in December were down, as I said, 140,000. If we lost 500,000, 500,000 in leisure and hospitality, why did we only lose 140,000? Because if you look across this graph, every other industry gained jobs in December, as they did ever since the partial opening started in May. Healthcare, and many of you know this, people didn't go to the dentist and they didn't go to the doctor, especially for like elective surgery. They stayed far away from any healthcare facility unless they had the virus. And therefore, as you know, there was a tremendous underutilization of space in healthcare. Now, people are starting to go to the dentist again or to the doctor. There's been some bounce back, but what I show in yellow with the stripes, I put on the stripes to make it very obvious it's different. That isn't December or January. That's not a month. That's the cumulative change in jobs since the peak in February. What's happened since the peak? So you can see leisure and hospitality is still down 4 million, which is a lot. The third category over, healthcare and social assistance, is down almost 1 million, and it took a big hit in April. I should have said, and I apologize, the second category over is called professional and business services. That is very relevant to you because these are the kind of people that are in offices: lawyers, accountants, consultants, managers, administrative people, computer programs. Now, more and more of that, of course, is WFH, but they had been in offices. And the big question ahead of us is, after everyone gets vaccinated, how many will head back to offices? And again, what kind of offices? High rises in the central core or smaller office parks further out. The good news is we have been creating jobs, bringing jobs back, I should say, every month. It's just that a lot of these people are still working from home, although frankly, many have been going back to offices as well. So we see the big job losses are in those three broad industries. Manufacturing took a hit. That's the fourth set right away. Factories closed. But then we've been gaining jobs every single month, including in December, that blue there. So at this point, we're only down 500,000 manufacturing jobs. Construction has bounced back very well. Look at that at the end. It's bounced back dramatically. It's outdoors, so it's safer. And you all know, and we saw it with the Case-Shiller numbers this morning, with house prices up 9.5% in 12 months. Highest increase in quite a long time. People want their single family home. We just saw a few days ago, housing starts are at something like a 12-year high. So construction workers are really getting back in there. Price of lumber at a multi-year high. So construction is back, manufacturing is coming back. The one that surprises me is retail trade. Because as you know, and if you, for instance, invest in REITs, for malls or regional shopping centers, you're hurting. Those REITs are not doing well. But retail trade as a whole, interestingly, things like big warehouse stores and super centers, they've actually done pretty well. And there's a lot of employment in those places. And also, of course, with the growth of e-commerce, that counts as retail. Amazon is a retailer. Etsy, which is doing very well, is a retailer, or Wayfair and Shopify, and they've created a lot of jobs. And as you know, and I was talking to Greg Bowler, there's huge growth in the warehousing and the building of this kind of industrial space, and that is jobs. It's still, there's a lot of robots in an Amazon 2.6 million square foot warehouse. I was just in one just being developed. I can't give out proprietary secrets. So there's a lot of robots, but a lot of people work in them. So as they're brought online, and the smaller, more urban, so-called last mile, smaller warehouses, there are also a lot of people working in them. So retail trade has not lost that many jobs, even if JCPenney is not doing too well, as you know. Okay, we'll move to the next slide. And as I move to the next slide, we're asking ourselves, how did the economy, which had just lost 22 million jobs and people were out of work and they didn't have their salary, how did the economy come back, turn on a dime and start coming back so quickly? Not that it was all the way back in May or June, but progressively. All right. I told you it was simple. Excuse me. We have gained back 12 million jobs of the ones we lost. So lost 22, gained back 12 million, month by month. So we're down 10 million. 10 million is a lot. We have about 150 million people employed in the US. So we've lost about 6% of the jobs. But hopefully, once we get this pandemic more under control, and I believe we will, again, more people will be hired. But when things were really bad, the two accelerators that economic policy can use both jumped in to get the economy growing. One, as you know, is called fiscal policy with an F, which is the federal government budgetary spending and taking in taxes. And the government spent so much money through the CARES Act. You remember PPP, the payroll protection. You remember the $1,200 checks they sent out to everybody. I'm not talking about the checks coming out now or Biden's plan to add 1.9 trillion. I'm talking about the CARES Act back around April, May, when well over $2 trillion was spent, and we extended unemployment compensation for people that were became unemployed and remained unemployed because the economy didn't do well. And by spending literally billions more, and remember with Donald Trump's budget, we already had a $1 trillion deficit, even if there was no pandemic. But then you add about $3 trillion of spending, and instead of going in debt in that next year of $1 trillion, because if you have a deficit, the federal government has to finance it. It has to borrow. If it spends $1 trillion more than it takes in tax revenue, that means it has a deficit. It's got to borrow. It issues treasury securities, and that means that's their debt. So the debt would have gone up $1 trillion if we were going along at the $1 trillion deficit level we had the year before. But instead, with the CARES Act and now the extra spending, I want to show you what's happened to the total federal government debt. So I start in the middle of 2018 to show you debt was rising. We had a deficit, but it was somewhat under control. It was a little over 21 trillion, which was similar to the size of our GDP, of our annual production. Then it rose. Then we had a so-called debt limit. Congress put a limit on it, so it didn't rise for a while, but that's kind of a joke. You're still deficit spending. You're just kind of cooking the books. So when they passed a higher debt limit, and then things jumped. So we have an increase of the rate of growth. But then if you look back at the middle of March of 2020, about 2/3 through, you see that kink and that vertical lift. That is when we came in with the CARES Act, and we went literally from a debt, which was huge, 23.5 trillion. Last night, it was 27.75 trillion. So as you see in the title, it grew 4.5 trillion, and it's still growing. As you know, we just passed a $900 billion further fiscal. Again, it's fiscal. It's putting the foot on that accelerator. You know, let's have the government spend that further $900 billion. Let's send a $600 check to everybody, etc. But now Biden wants to add 1.9 trillion on top of that. And if, you know, in this case, of course, the debt would really, really skyrocket. And that's even before we talk about something like a Green New Deal and increasing infrastructure spending. I'm not here to judge what's good, what's bad. I'm just trying to give you the data and the mathematics of it. But the key is we did create 12 million jobs. We didn't fall into a depression and make it a Great Depression that lasts for a long time. But still, this debt will be there, and it will accelerate with the current new packages of spending. I'm going to move to the next graph. I mentioned there's two accelerators. One is fiscal policy, and as you know, the other one is monetary policy. The Federal Reserve, when things are bad, trying to expand the economy, have an expansionary monetary policy to expand the economy. How do they do that? By expanding the money supply, expanding the supply of credit, basically making it easier for banks to provide credit and provide credit at low interest rates. Now, you're a sophisticated audience. You know that we are at all-time lows for mortgages. Just refinance a 15-year fixed mortgage at an APR of 2.25%. No wonder people are buying single-family homes, and builders have now very much ramped up the housing starts and asking for permits, which is a leading indicator of what's going to happen for single family homes, not as much multifamily. People don't want to live in an apartment and bump into other people now in a pandemic. Again, it's these low interest rates. But how did we get low interest rates? The Federal Reserve, when they want to stimulate the economy, goes over to banks, basically, buys bonds from them. You see, banks, their liability are deposits from people like us, but their assets are loans they can make on commercial real estate, for instance, but they also hold bonds, maybe to diversify, so it isn't all loans in case the loans go bad. But the Federal Reserve, through open market operations, they go into the open market. If they want to boost the amount of credit in the economy, kind of print money, they'll buy bonds, they'll bid for bonds, bid up the price by having a demand for bonds until banks are willing to sell them. And then the Federal Reserve sets up what's called reserves, which the individual banks like a Citigroup need reserves, or a Truist, a BB&T, whatever, they need reserves at the Federal Reserve in order to make more loans, like more real estate loans. So the more the Federal Reserve buys bonds, the more they're expanding the money supply and the supply of credit to expand the economy. This started at the beginning of 2008 when the mortgage bonds were crashing, as you know, when The Big Short, great movies like that came out, Too Big to Fail about the banks came out. And for the first time, we saw the Federal Reserve buying a lot of mortgage bonds. And that's the blue. They were buying mortgage bonds to support the price of mortgage bonds and make it possible for banks to provide mortgages, because we were in that real estate crash, as well as the Federal Reserve, which always held treasury bonds to do these open market operations to either expand the money supply by buying bonds or shrink it if the economy is booming. And you can see later on the green comes down. When the economy had been growing very fast, the Federal Reserve actually had what's called a contractionary monetary policy. They tried to slow down the economy by selling bonds and taking some money out of the system. That's what President Trump was so mad about. But then you can see the green, which is the total Federal Reserve assets on their balance sheet, bonds on their balance sheet, shot upwards. And notice the red, which is the Federal Reserve holding of Treasury securities, shot up. In other words, the Fed was basically funding that huge spending by the Treasury, by the federal government. Notice the Fed had held $2 trillion of Treasury securities coming into this pandemic, and now it holds $4.75 trillion. In other words, they just bought $2.75 trillion of Treasury securities. Funding, that's the size of the CARES Act, all that extra spending we did in fiscal policy. So you can see how these two graphs relate. It's kind of like we're doing government spending and the Federal Reserve is monetizing it. It's in some sense printing money to pay for the government spending. But interestingly, the green, which is the total assets held by the Federal Reserve, the total bonds, if you see the green has gone up even more than their holding of Treasury securities, the red, that's because they are buying mortgage bonds. And that's very relevant to you, which is why I'm showing this, to support the mortgage market. When things look bad in April, they stepped in and they bought a lot of mortgage bonds, and they still are. You see, they're not buying them at that tremendous surge you saw around April, May, June, but they are buying on net $40 billion of mortgage bonds every month. So that's a lot, and they're buying more treasuries. Remember when we talked about QE1 and QE2, you see that at the beginning of this graph. QE means quantitative expansion of the money supply, of the amount of credit available. And you see 3 step-ups back between 2008 and 2014. Even in the earlier Obama years, once the economy started growing, it was growing slowly. So the Federal Reserve, wanting to have an expansionary monetary policy to expand the economy, expanded the money supply by, once again, buying bonds. You can see the blue and the red was going up around 2012, 2013 to stimulate the economy. Then where they came down, that was the so-called taper, when we were getting worried about inflation, when unemployment came down to a 50-year low of 3.5%. And then we've had this, what we call QE infinity, just spending almost infinitely to get the economy growing. Will this be inflationary? I'm sure you're wondering, especially because real estate is often sold as an inflation hedge. We will move from the current 1.5% a year inflation to a little over 2%, I believe, in the next year and 2 years. But then we may move beyond that, in which case the Federal Reserve might have to say, you know, we don't want to be heading toward 3%. We don't want to build in this psychology of inflation picking up, and then people will ask for higher wages because they have to pay more for their consumer products. So the Federal Reserve may tighten up at some point. I do look at for the 10-year bond. I'll move to the next graph. But as I move to the next graph, I do want to say that I don't think interest rates really have a chance to go very much lower. They won't go much higher. But for instance, the 10-year bond, Treasury bond, which is the lowest interest rate bond because the Treasury can always print money to pay itself off. So it's the risk-free bond. I show you in blue single B bonds. These are issued by corporations. They're not quite junk bonds, but they're higher risk. These companies could go broke, so people demand a higher interest rate to hold them. You see right now, the blue, people are getting 4.5% interest to hold this kind of bond. A AAA, like an Amazon, for instance, or an Apple, if they borrow, these are very solid companies. They're probably not going to have to default on their debt. They're paying about 1.8%, much less than a riskier bond, the blue, but more than a Treasury bond. You see the yellow, the 10-year Treasury is just over an interest rate of 1%, as I said. It had been as low as about 0.7. By the way, I'm just showing you 2019 and 2020 up till yesterday here to show you that rates were coming down in 2019. President Trump was really pressuring Jay Powell at the Fed to lower rates, and they were doing some of that. And in the marketplace, people felt secure. The economy was growing. So even firms that were not of the credit rating of like an Amazon, these single B firms, people felt even fairly secure holding their bonds. They didn't think the risk of default was very big. So they were willing to hold them at a 5% interest rate. But at the beginning of 2009, it was an 8% interest rate. Then in April, we didn't know literally if the financial system was going to fall apart. It was like when Lehman Brothers went broke and the financial system crunched. So people would still hold a treasury. You could see the interest rate even came down on treasuries as the Federal Reserve, as I just showed you, was buying a lot of treasuries, pushing up their price. And as you know, the interest rate on a bond moves inversely. If the price is high, the yield to maturity on a bond comes down. But people didn't want to hold risky bonds. They thought these companies could go bankrupt. And of course, many companies did go bankrupt. So they literally wanted 12, 13% interest rate on these single B bonds. But then the system held together. The Federal Reserve held it together through this QE infinity. And people started being fed up, sitting around holding, getting 0.7%, 70 basis points, 80 basis points, holding a treasury bond, or almost zero if it was a shorter term thing like a treasury bill, or put their money in the bank and earn almost zero. So as the economy has been looking stronger, people felt like, you know, a lot of these single B credit rated companies, they won't go broke. I think I'll buy their bonds. The price of the bonds went up, and the interest rates have come down a lot. Now, they still are somewhat risky. You know, at 4.5%, I'm not sure that these are bargains anymore, earning 4.5%. But the orange, the spread, the extra interest you get holding a single B bond compared to a treasury, the extra interest you get because you're taking on more risk. Notice how it spiked in the bad days in the spring. And now it's down about as low as it's been in years. This is called TINA. There's no alternative, basically. People just don't want to sit around earning 1% interest. And that's why the stock market has gone up. That's why some aspects of real estate are getting strong, in timberland and farmland and gold. It's because of TINA. People just don't want to earn the very low interest rates on safe assets like treasuries. I only have a minute left, but I'll just show you a last graph for 1 minute. So as I pull up that last graph, I can do it in a minute because housing starts were wild high in 2006. That's where they peaked. Starting in 98, they were around, this is the red, they were around our long-term average of about 1.3 million. Then they went up, that's single family, the red. They went up because we were doing a lot of single family during the housing boom. Then it just crashed. Blue is multifamily. We never do as much multifamily as single family. Even if there's a multifamily that has 100 units, we count that as 100 units. But even then, we still don't do as many units as we do single family. That's the US. Europe is very different. But notice, multifamily, the blue hasn't been rising at all for years, but we have a spike up in single family, the highest it's been since before the crash in 2007. And it is just spiking up. So it isn't just rumor that people want to move out to Alpharetta or Johns Creek or Roswell or Cobb or Sandy Springs and live in a single family home. I gave you the local analogies. Of course, this is national data. But the other thing I want you to see is that housing permits are at the highest they've been since they were too high, since the bubble that burst around 2007. And again, that's a leading indicator. You see a permit, 2 months later, we see developers start to build a house. So you know a lot about commercial. I wanted to show you the behavior we're seeing in housing. And again, this means these people want to live out in an Alpharetta, for instance, where they can get a single family house, more house for their money than in Midtown, for instance. And that's because they're probably not going to all work in an office tower downtown or in Midtown. They're going to be working in lower rise further out. Okay, let's take some questions, and I'll have you fire those questions right at me. We have a technique to do that.
Thank you, Dr. Rosenzweig. We do have a question, and it relates to the growing deficit. So the question is, what does it take to get control of this huge continuous growing deficit?
Yes, brilliant question, because I'm worried because we are continually revising upward our forecasts of deficits this coming year. You know, it had never been more than 1.4 trillion, which it was when we had a stimulus in 2008, 2009 in the so-called Great Recession. It was, as you know, over 3 trillion. We thought it would go down because that CARES Act was so huge, but now you add the 900 billion, and even if in negotiating with the Republicans, even if Biden only gets, let's say, 1.2 trillion, you add that with the 900 billion, you're already over 2 trillion of new stimulus. And that's before they get a bipartisan infrastructure bill, which they may. And we would have been running a deficit even before the 900 billion I'm talking about, maybe the 1.2 trillion that's coming. So we're a long way from getting control on our deficit. And the problem is deficits don't fully go away. You might say, okay, it's a new year. Maybe we can balance our budget or only have, let's say, $1 trillion deficit. But again, a deficit means you have to borrow, and that means more debt, and you have to pay interest on debt. So what is saving us now, as Janet Yellen said in her testimony, and now she's been confirmed as Treasury Secretary, is these record low interest rates. So we have all this debt, but interest rates are low. My fear is if interest rates ever rise, and they probably will, you know, in a year, we're going to have over $30 trillion of government debt. In a few years, more like 35 trillion. What if interest rates rise to 2 or 3% on government debt? That means we're paying so much interest, we will probably continue to have deficits in the future. We got to fund more Social Security and Medicare, as I mentioned, as the rest of the baby boom retires. I'd like us to keep a strong national defense in this world of so many geopolitical risks and the rise of China's military, for instance, and Russia being so aggressive militarily. So we got military, defense rising, Medicare, Social Security, and interest will rise, interest payments by the government. Some of this may lead to inflation at some point, where the government tries to reduce the purchasing power, the real value of the debt. I think we're already doing that by printing so much money that will eventually lead to some inflation. What does that mean for you? It's actually good, because people see real estate as an inflation hedge, as opposed to fixed income, like bonds and bank accounts, for instance. People see real estate as a hedge. I spoke to a group of leading farmers the other day. Farmland and timberland are doing very well. They're feeling good about themselves. Okay, next question.
So following up on that, Dr. Rosenzweig, someone asked about how concerned we should be about the value of the US dollar given these massive deficits.
Well, that's a brilliant question. And I actually am an international finance professor, as Chef and others know. So this is what I follow. And we have to be concerned. The dollar actually has started falling as our debt in the last 6 months, as our deficits were so large and we printed so much money. And, you know, it's when there's an excess supply of anything, like if there's an excess supply of dollars, the price falls. Like if there's an excess supply of, I don't know, let's say Class A office space, its price would fall. Or if excess supply of mall space, its price will fall. So with this printing of dollars, its price has fallen against a lot of currencies. And a lot of leading investment banks, et cetera, forecast that the dollar will continue to fall. I'm not so sure, because we're not the only country that has a pandemic. And the others are also printing euro and Japanese yen, et cetera, to try to stimulate their economies. So we're not the only one with an expansionary monetary policy. And we've already had some falls in the dollar. On the other hand, the smart money does seem to be saying that the dollar could easily be under some pressure, even in the next few years, because who wants to hold a currency that's losing purchasing power if we do have inflation? And there is a risk that one day we won't even be the reserve currency, the currency that everyone holds and every central bank holds. Just if there's a rainy day, they hold some dollars in reserves. I personally think the dollar will still be the world's reserve currency for at least 15 years. The euro has its own problems. Europe has its own problems, like Brexit. China still has a lot of problems with transparency. Of course, the next time I come on, we can talk about, will there ever be digital currencies replacing the dollar? Let's get up one more very fast question, and then I'll hand it back and keep you on time.
Well, Dr. Rosenzweig, I don't know that we have a quick question.
All right.
But,
All right.
But I'm going to give you this one anyway, because I'm sure it's something that would be interesting to everyone. But high level, which initiatives of the current administration are poised to deliver positive overall economic results for the U.S., and which initiatives of the current administration keep you up at night?
The initiatives is sending out these checks to just about anybody. It's $2,000 per person. So like a family of 6 gets like 12,000. And yeah, you know, the people on the call, or even myself, maybe we don't get them or get the full amount because our incomes are good. But if someone has their job and they're making 70,000, they get all that money. This is just spending. The government is overspending. What we do need maybe is people that are unemployed through no fault of their own. Let's say they work in a restaurant. You know, usually the state only gives a certain amount of weeks of unemployment. These people actually can't pay their rent, or they're really hurting There's malnutrition rising. I'm in favor of extending the amount of weeks or even months will give people unemployment compensation until their businesses come back. So that's an excellent question. Because I teach young people, I am very worried, and I have kids and even grandkids, I am worried about global climate change. I don't want the full trillions of dollars of a Green New Deal, but I do want us to do some intelligent things with climate change, which also create jobs, like retrofitting buildings, commercial buildings, and housing makes a lot more difference than electric vehicles or anything else. Just putting better windows in buildings make a much bigger difference toward ameliorating the world's climate. Well, thank you very much, and I'll hand it back over.
Can I get you to answer one more question? I know.
I love it.
I think this is an interesting one, so I'm just going to throw it out there. So do you think that investing in Bitcoin is a good strategy to hedge against the US dollar?
Well, you know, it's such a worrisome thing to talk about because I'll be wrong. You know, it was 4,000 a year ago. Then it went up to 40,000. Now it went down to 30. It's around 30,000. So first of all, I don't want to give anyone advice, because what if it was 40 and it went to 30 and you put $100,000 in and you just lost 25,000? I guess my overall answer is, as a finance professor, it is time to diversify as widely as possible. And cryptocurrencies could be a part of people's portfolio, but it's a little bit like buying Etsy now or Wayfair or Shopify. You know, where were you a year ago when these things were literally 1/10 of their stock prices now? And GameStop, which is, you know, went crazy yesterday, up and down. GameStop has risen like 25 times. So some retailers are going broke. E-commerce retailers like Wayfair have done well. Ones that get involved with games are doing well. I say this because it's the Wild West out there. So be very diversified, including some very safe assets. I've got some money in the banks that are sponsoring this particular talk, even though the interest rate is low, because we live in very volatile times. Stock market was down 34%, then up 75%. As I say, Bitcoin all over the place. GameStop yesterday, 75, 170, 100 in one day. So diversify, including some emerging market, low cost mutual funds. But, you know, I could be wrong about emerging markets. Those are going to go up and down. I just think long term they'll go up. So stay widely diversified, including some very liquid assets. Yeah, I don't like earning a low interest rate, but some FDIC money in one of our banks is not a bad idea. Not when a stock market could lose one third of its value like that. Or Bitcoin lost a quarter of its value in a week. Well, thank you very much. And I'll turn it over to my friend Shep.
Okay, thank you, Jeff. Timely topics and interesting topics and fascinating data, and as always, a great perspective. So appreciate you joining us, and we look forward to having you back in the future.
Yes.
I'd like to take this opportunity to thank our sponsors again: BB&T, SunTrust, now Truist, Brassfield and Gorey, Highwoods Properties, Majestic Realty, Mayberry Electric, Nelson, Ryan, and Troutman Pepper, our platinum sponsors, and KBD Group and Randall Paulson, our premier sponsors. That's a wrap for our meeting. As I said in December, we're going to be creative this year. So the board's going to work hard. We got some great ideas, and we'll have more on that soon. So please stay tuned for future events. And that's a wrap. I hope everybody has a great day.